On October 9, 2025, Citi signaled a decisive change of stance on Argentina's local debt by going long the Bond 30, a 30-month bond tied to the peso but subscribed in U.S. dollars. The decision follows a conspicuous intervention by the U.S. Treasury aimed at stabilizing Argentina's battered currency and restoring market confidence. Citi's move is being read by investors as a bet that external support reduces tail risk enough to allow local currency assets to reprice downward from crisis levels. Bond 30 occupies a distinctive niche. Although its coupon and principal are linked to the peso, the initial subscription is in dollars, giving foreign buyers partial insulation from a sudden peso collapse while still exposing them to local economic conditions. That hybrid structure makes it an attractive instrument if currency volatility can be contained, exactly the outcome Citi appears to be anticipating after the U.S. measures. The U.S. intervention has three visible components. First, the Treasury purchased pesos directly on the market, an unusual but forceful step intended to calm extreme FX moves. Second, Washington put in place a dollar liquidity buffer through a sizable currency swap facility with Argentina's central bank, giving Buenos Aires more breathing room to meet dollar demands without immediately depleting reserves. Third, and perhaps most important for markets, the actions carry strong signaling value. They indicate political will in Washington to prevent a disorderly collapse that would have spillover effects in regional markets. Citi's strategy rests on the economic logic that a credible external backstop compresses risk premia embedded in local bond yields. In practice, if traders believe that U.S. support will restrict peso volatility and shore up Argentina's short-term financing, demand for instruments like Bond 30 will increase, pushing prices up and yields down. The bank's timing also reflects calendar risk. Argentina faces legislative elections later in October, and Citi appears to judge that the worst of immediate panic is already priced in, or at least that the Treasury's intervention materially lowers the probability of catastrophic outcomes. Yet the trade is far from risk-free. Election outcomes remain a powerful unknown. A surprise political shift or an adverse policy signal could reverse sentiment quickly, reigniting currency pressures and pushing losses onto holders of peso-linked instruments. Equally, the durability of U.S. support is not guaranteed. Political opposition at home, changing priorities, or evolving assessments of Argentina's reform path could lead Washington to scale back its assistance. That would expose investors to both currency and sovereign risks anew. Beyond the immediate trade implications, the episode has broader significance. Geopolitically, the U.S. intervention underscores Washington's renewed willingness to use financial tools to influence outcomes in Latin America and to preserve market stability. For global investors, it may recalibrate how emerging market risk is priced. If major economies signal a readiness to step in during crises, investors may accept lower spreads on certain sovereigns, at least temporarily. That dynamic raises its own questions about moral hazard. Repeated rescues can encourage risk-taking and delay necessary domestic reforms. For Argentina, the window opened by the intervention could be an opportunity to lock in calmer financing conditions and press ahead with credible fiscal and monetary measures. But underlying structural problems, high inflation, persistent deficits, and a history of defaults, remain. Any lasting improvement will require tangible policy discipline and institutional repair, not just temporary liquidity injections. Investors and policymakers should watch several indicators closely in the coming weeks: the tone and scale of U.S. Treasury communications, the stability of the peso versus major currencies, short-term bond yields and spread movements, and any signals from Argentina's government about fiscal or monetary adjustments after the election. If the U.S. support proves steady and Argentina shows policy coherence, Citi's long in Bond 30 could be vindicated. If not, the position could serve as a reminder that political risk and structural vulnerabilities in emerging markets can reassert themselves quickly, even after high-profile rescues.